Everyone thinks Tulip Mania was history's first stock market crash. They're wrong, and the truth is far more calculated. The story we've all heard goes like this. 17th century Holland went mad for tulips. Speculators bid prices into the stratosphere. A single bulb sold for more than a mansion. The market collapsed overnight and the entire nation faced financial catastrophe. It's the textbook example of irrational exuberance, the proof that humans have always been prone to bubble fever. Except that's not what happened. Let's start with what we know for certain. Holland in the 1630s was the wealthiest nation on earth. The Dutch East India Company, the VOC, had turned global trade into a machine that printed money. Amsterdam's merchants controlled spice routes, silk corridors, and slave routes worth billions in today's currency. Wealth accumulated faster than anyone had mechanisms to spend it. Into this vacuum stepped the tulip. Tulips weren't native to Holland. They arrived from Turkey, exotic and fragile, requiring skill and patience to cultivate. What made them genuinely valuable wasn't speculation, it was biology. A virus infected the bulbs, creating striped and flamed patterns. These weren't consistent. A grower couldn't predict the colors. You planted a bulb and gambled on what bloomed. The rarest specimens, the ones with perfect striations, could take years to produce. By 1634, the rarest varieties, the Semper Augustus, the Viceroy, weren't luxury goods, they were assets. Wealthy merchants, surgeons, and ship captains began collecting them, not to admire in gardens, but to own, to possess something scarce. A single Viceroy bulb could sell for 500 guilders. For context, a master craftsman earned about 300 guilders annually. You could buy a townhouse in Amsterdam for less. Here's where the conventional story collapses. The famous crash at tavern auctions, where bulbs supposedly sold for astronomical sums before the market evaporated, never happened the way historians claimed. There were no frenzied auctions where bulb traders lost everything overnight. The evidence simply doesn't exist in the records. What actually happened was far more mundane and far more revealing about human behavior under pressure. Bulb trading operated through a futures market. Growers sold bulbs that wouldn't be ready for harvest for months or years. Buyers paid deposits, sometimes substantial ones, betting on future delivery. They were making calculated decisions with incomplete information, exactly like any forward contract market today. The prices rose because supply was genuinely constrained. The virus that made striped tulips beautiful also made them unpredictable and slow-growing. A single Semper Augustus bulb might produce only 1 or 2 offsets per year. Demand from the wealthy merchant class vastly outpaced supply. This wasn't irrational. This was supply and demand working exactly as economic theory predicts. Between 1634 and 1637, prices did climb sharply. But they climbed among a specific subset of the merchant class, wealthy enough to absorb losses, educated enough to understand the risks, and positioned to benefit from owning rare assets. This wasn't a nation gripped by fever. It was a market functioning within its constraints. Then came February 1637. Winter, bulbs sitting dormant in the ground. Suddenly, buyers stopped appearing at auctions. Growers realized they'd overcommitted. Contracts that seemed safe now looked risky. Prices didn't crash catastrophically. They simply stopped. Buyers walked away. Sellers held inventory they couldn't move. The financial damage, minimal. Most contracts were never enforced. Buyers claimed force majeure, the sudden collapse of demand. Sellers, facing legal costs and uncertain recovery, often accepted nothing rather than fight. Some losses occurred, some fortunes shifted. But Holland didn't face a financial catastrophe. The economy didn't crater. Life continued. The myth of Tulip Mania was constructed later by 18th and 19th century writers who wanted a cautionary tale about speculation. They embellished, they invented, they created a narrative of collective madness that never existed. What they missed was something far more interesting. A functioning market responding rationally to real scarcity. The real lesson isn't about avoiding bubbles. It's about understanding what decisions people make when they possess valuable information and face real constraints. The Dutch merchants who bought tulips weren't fools. They were investors operating in a market with genuine scarcity, high barriers to entry, and real opportunity costs. They made bets. Some won, some lost. That's markets. Holland recovered because the tulip market was never systemic. It didn't involve the banking system. It didn't threaten credit chains. It was a luxury asset market among the wealthy. When it contracted, the economy absorbed it. The lesson for us isn't simpler, it's more complex. Not all financial volatility is irrational. Sometimes it's the rational response to incomplete information. What happened to the tulip market after 1637? It stabilized, prices normalized. Tulips remained valuable, but as a luxury good, not as a speculative asset. The virus-infected varieties were still scarce. They still required skill to grow. Wealthy collectors still wanted them. The market found equilibrium and stayed there for centuries. There was no crash because there was no bubble. There was only supply meeting demand. Then demand receding. The Tulip Mania myth persists because it's useful. It lets us feel superior to the past. It lets us believe we're more rational than our ancestors. It gives us a neat story: greed, excess, collapse, lesson learned. But the actual history is messier and more instructive. Markets don't always behave like panicked crowds. Sometimes they're just people making calculated decisions with the information they have. The real vulnerability isn't speculation. It's leverage. It's systemic risk. It's when a single market failure can topple banks and freeze credit. Tulips couldn't do that, but mortgages could, derivatives could, assets whose true value no one could calculate. That's where real danger lies. And that's the distinction most people miss when they invoke Tulip Mania as a warning. Tulip Mania teaches us something uncomfortable. Sometimes markets are rational. Sometimes people know exactly what they're doing. Sometimes the problem isn't collective madness, it's that we're all making logical bets on incomplete information, and when that information changes, the bets unwind. That's not a failure of judgment. That's how markets work. And understanding that distinction is the difference between learning from history and merely feeling reassured by it. Subscribe to explore the financial decisions that looked rational at the time but reshaped history. There's a new case every week.